Okay, and welcome back, students who are taking financial accounting. And in this series of videos, we are working on the assigned problems for the Chapter 3 short exercises. And in the last video, we did 4, 5, and 6. So let's pick up with number 7. Right? Okay. And so this one here is an adjusting entry for magazine subscription. Right? Backcountry Inc., an outdoor magazine, collected $2,700 on June 1st for 1-year subscriptions from subscribers in advance. Okay, so the subscribers are prepaying because they're paying in advance. Okay. Now here's the subscriber. And here's the magazine. Oops, let me do it this way. And here's the magazine. And if you've watched the last video or the theory videos, you'll know that when the subscriber prepays, that's prepaid, that's an asset on the subscriber's books, and on the magazine, all right, that's unearned revenue, which is a liability to them. Okay. So they collected $2,700 on June 1st for 1-year subscriptions in advance. Journalize and post the adjusting entry on December 31st. So this is June 1st, and they're going all the way to December 31st. And they collected $2,700 as prepaid, right? Journalize and post the adjusting entry on December 31st to record the revenue that Backcountry has earned, Backcountry being the magazine. Okay. Assuming no other adjusting entries have been made for the year, compute the balances of the two accounts involved. Right. So this here, $2,700, is a prepayment for 1 whole year. So I'm just going to make this, X1, or let's just call it 01. And so this will go all the way to 5/31 and the year is 02. Okay, because they're paying $2,700 for a 1-year subscription. So 2,700 divided by 12 is $225 a month. Is how much the subscription is per month. Now it's going from June to December 31st, right? Pay attention here, and this is why I like drawing a timeline in order to be able to understand. A lot of people will automatically go and say, okay, so it's going from June to December, and they're going to say, oh, well, June to December is 6 months. Just because June is 6 months through the whole year. Don't do that. Okay. Draw the timeline so that you understand where you are date-wise, so you can calculate the correct number of periods. It's easy to mentally say June to December is 6 months. Okay, because why? December is the 12th month and June is the 6th. 6 from 12 is 6. Okay. But watch what happens here. Okay. This here date is June 1st. Okay, so we go to July 1st, August 1st, September 1st, October 1st, November 1st, and let me do this, call this December 1st, and then call this December 31st. Right? Because we're starting on June 1 and we're going to December 31, right? So this is 1 month, this is 2 months, this is 3 months, 4 months, 5 months, 6 months to get up to December 1st. And for the month of December, that's a seventh month. So if we're earning $225 a month times 7 months, that's going to give us an amount of $1,575 that we've earned. Okay, so if you, like I said, if you're using 6 months, you're going to be wrong. Okay, because you have this, we're looking at the date, all right? The 1st through the 31st here, all right? So we have 1,575 out of the 2,700 that's been earned, okay? So the difference between the two means we should end up with $1,125 in our unearned revenue account, right? So we have to adjust the unearned revenue account, and that's what this problem is asking for. It's asking about backcountry, which is the magazine. We would have to do the same thing with our subscriber here, because why? The subscriber actually used it up. From the subscriber's perspective, all right, let me erase this. That's there's $2,700 in the prepaid account. Well, we know that's a debit because it's an asset. So if we've used up $1,575 of it, right, that means we'd have to credit that prepaid account. So we'd credit prepaid, I don't know, we can call it subscription, prepaid subscription, for 1,575, and we would debit something else, and that would be, so say, a subscription expense account, okay, for the 1,575, right? But that's from the subscriber side. This particular problem, that's the adjusting entry from the subscriber side. But this particular problem is asking about backcountry, which is the magazine user, right? So they had a liability, but because they owed the, they had received the full 2,700, right? But now it's been used up, right? So I know that my unearned revenue account has $2,700 in it, and that's a credit because it's a liability account. The normal balance of a liability account is a credit. It's what increases that category of account. So I have a credit for 2,700. Well, since I'm reducing that, well, the opposite of that is a debit. So I have to debit my unearned, whatever I'm going to call it, subscription revenue, for 1,575. Okay, and of course, if I debit something, I have to credit something else. Well, what am I talking about? I'm talking about subscription revenue. And so if I looked at my chart of accounts, I'd probably see a subscription revenue account, and I would credit that for 1,575. So that's going to be my journal entry. Now, let me erase this stuff up here and look at the T account so that we can see what the balance in that account is going to be. All right. So I have a T account for unearned subscription revenue, and I'm going to have an account for subscription revenue. Okay, and on June 1st, all right, we received $2,700 on June 1st from the subscribers. Okay, and of course on June 1st we have nothing in our revenue account, okay, because it's June 1st. We haven't used any of it. But now we've gone and, as of December 31st, we need to record the adjusting entry for the usage of that revenue, all right? So I have a debit to unearned subscription revenue for $1,575, and that's as of 12/31. And I'm recording that a credit for $1,575 to subscription revenue, right? And of course, when I calculate the balances in those accounts, That's going to leave me with a balance of $11.25 as of 12/31 in unearned subscription revenue, and a credit in the revenue account for 12/31, for $15.75. Okay. A thought just occurred to me. Don't just automatically assume that these numbers need to be the same. They're not going to be the same, right? Because remember, you still have, some months, 5 more months here that haven't been earned yet. Okay. So, at the end of, that 5 months, then we're going to end up with a full $2,700 in our subscription revenue, but we're going to end up with 0 in our unearned subscription revenue account if we keep on making adjusting entries. Okay, so I hope you understood that. Go ahead and pause it, rewind, watch it again. The most important takeaway that I want to give you from this video is that use the timeline, right? So that you visually can see what the period of time that you're thinking about. You have to pay attention to the dates. Okay, doing the math is relatively easy. 2,700 divided by 7, is what, 225. Times the 7 gives you the 1575. And if you've done the previous exercises, you can see that it's basically doing the same kind of math. It's just different accounts, and just become accustomed to knowing which accounts you're working with. Okay, so making adjusting entries, even though these are short exercises, it's important that you get a handle on them, because as we work through, if you saw the theory videos, I had talked about the worksheet. And on the worksheet, the accountant goes down through each and every single account and figures out what the balance should be in those accounts and makes the adjusting entries for them. And as we go through some more of these here exercises and problems that that have been assigned to you, okay, basically that's what we're going to be doing. We're going down through each and every account, and we're saying, okay, here's what the balance was. Here's what the balance needs to be. Well, how do you go from what it was and what it needs to be, right? You have to figure that out, and when you figure out that amount, then it becomes relatively easy to make the adjusting entry. All right. Now notice I had talked about making the adjusting entry in the perspective of am I affecting cash? Am I affecting receivables and payables? And I had said no and no. But also in the theory videos, I had said most often when you're using adjusting entries, you're making adjusting entries, you're not going to be using that part of the process. You're not going to be thinking about cash or accounts receivable and payable. Those two questions to make a journal entry when you don't know how, asking yourself those questions is great for when you're having transactions that occur during the course of an accounting period. But when you come to adjusting entries, you basically work with what you know and go off of that, because as you can see, like unearned service revenue, subscription revenue, you're going to have a subscription revenue account. They kind of like pair themselves up, and it's easy to see, as what accounts relate to each other. Okay, and as you do more of these problems, it'll become more intuitive, and to the point where it just sort of all clicks in place, and you don't have to think about it so much. Okay, so with that said, I'm going to stop here and pick up with 3-8 in the next video.